The Bank of Canada is preparing to announce its final interest rate decision of 2024 on Wednesday, December 11th. This highly anticipated announcement is expected to mark the fifth consecutive rate cut this year. The central bank is responding to growing concerns about the health of the Canadian economy. Currently, the benchmark interest rate sits at 3.75%. Initially, economists predicted a modest 25 basis point cut. However, recent economic data has been weaker than expected. This shift has led to a change in expectations. Now, many anticipate a more aggressive 50 basis point reduction. Interest rate swap markets reflect this sentiment. They are currently pricing in an 85% chance of a 50-point cut. This decisive action would signal the Bank of Canada's commitment to stimulating economic growth. The potential for a larger rate cut highlights the uncertainty surrounding the Canadian economy. The Bank of Canada is walking a tightrope. It needs to balance the risks of inflation with the need to support economic activity. Several economic indicators are flashing warning signs, prompting the Bank of Canada to consider further interest rate cuts. One major concern is the sluggish pace of economic growth. Recent data revealed that Canada's economy expanded by a mere 1%. This anemic growth is far below expectations and has sparked fears of a slowdown. Adding to the gloomy outlook is the rising unemployment rate. November witnessed a worrisome increase in unemployment, suggesting a weakening labor market. This unexpected rise in unemployment is a clear indication that businesses are hesitant to hire. It points to a lack of confidence in the economy's trajectory. Adding fuel to the fire, some experts believe that Canada might already be in a recession. Former Bank of Canada Governor Stephen Poloz has suggested that the country is experiencing a stealth recession. Population growth, he argues, is masking the true extent of the economic downturn. Despite these concerns, inflation remains relatively under control. It continues to fall within the Bank of Canada's target range of 1 to 3%. This factor provides some leeway for the central bank to cut rates without triggering a surge in prices. The looming rate cut has sparked debate among economists. There is no consensus on the ideal size of the reduction. BMO and Scotiabank, for instance, now advocate for a bold 50-point cut. This shift in stance follows the release of disappointing jobs data. CIBC Capital Markets also supports a larger cut, particularly if the Bank of Canada aims to lower rates below 3% in the near future. However, not everyone is on board with such an aggressive approach. Some experts urge caution. BMO's chief economist, Doug Porter, acknowledges the likelihood of a 50-point cut. However, he sees a stronger case for a smaller reduction. Scotiabank economics Derek Holt expresses outright opposition to a 50-point cut, fearing potential negative consequences. The potential impact of a significant rate cut on the Canadian dollar, also known as the Loonie, is a major concern. The Loonie has already been on a downward trend. A wider interest rate differential between Canada and the United States could exacerbate this depreciation. The Bank of Canada's interest rate decision will have far-reaching implications for the Canadian economy. A rate cut, particularly a large one, is intended to stimulate economic activity. Lower interest rates make it cheaper for businesses to borrow money for investment and expansion. For consumers, lower rates can translate into lower borrowing costs on mortgages and other loans. However, there are also potential downsides to consider. A weaker Canadian dollar makes imports more expensive, potentially fueling inflation. It also makes Canadian exports more competitive, which could provide a boost to certain sectors. The Bank of Canada faces a delicate balancing act. It must weigh the need to support economic growth against the risks of inflation and currency depreciation. The upcoming interest rate announcement will be closely watched by businesses, investors, and consumers alike. It will provide valuable insight into the Bank of Canada's outlook for the Canadian economy in the months ahead.